Reading 53, Introduction to Asset-Backed Securities. Learning outcome, the candidate should be able to explain benefits of securitization for economies and financial markets, describe securitization, including the parties involved in the process, and the roles they play, describe typical structures of securitization, including credit trenching and time trenching, describe types of characteristics of residual mortgage loans and the typical and that they are typical securitized. Describe types of characteristics of residential mortgage-backed securities, including mortgage pass-through securities and collateral mortgage obligations, and explain the cash flow and the risk for each type. Define repayment risk and describe the prepayment risk of mortgage-backed securities. Describe characteristics of risk and risk of commercial mortgage-backed securities. Describe types and characteristics of non-mortgage asset-backed securities, including the cash flows and risk of each type. Describe collateralized debt obligations, including their cash flows and risk. Introduction. Previous readings examined risk characteristics of various fixed income instruments and the relationship among maturity coupons and interest rate changes. This reading introduces an additional level of complexity to fixed income instruments created through a process known as securitization. This process involves transferring ownership of assets from the original owners to a special legal entity. The special legal entity then issues securities backed by these assets. The assets' cash flows are used to pay interest and repay the principal owed to the holder of the securities. These securities are referred to generically as asset-backed securities, or ABS. The pool of securitized assets from which the ABS's cash flows are generated is called the collateral. Assets that are used to to create ABSs are known as securitized assets. These assets are typically loans and receivables and includes, among others, residential mortgages, loans, commercial mortgages, automobile or auto loans, student loans, bank loans, accounts receivables, and credit card receivables. Advances and innovation in securitizations have led to securities backed or collateralized by all kinds of income-yielding assets, including airport landing slots and toll roads. This reading discusses the benefits of securitization, describes securitization, and explains the investment characteristics of different types of ABSs, or asset-backed securities. The terminology regarding the ABS varies by jurisdiction. Mortgage-backed securities and ABSs backed by a pool of mortgages are a distinction and sometimes made between MBS and ABS backed by non-mortgage assets. Benefits of securitization for economies and financial markets. The securitization of pools of loans and receivables into multiple securities provides economies and financial markets with a number of benefits. Traditionally, the purchase of such assets as houses and autos have been financed by loans generated by financial institutions such as commercial banks. For investors to gain exposure to these loans, they must hold some combination of deposit, debt, or common equity issued by banks. This creates an additional intermediary between the borrowers and the investors. In addition to by being constrained to hold banks' deposits and securities, investors cannot gain exposure to loans only. They are also affected by economic risk undertaken and other bank activities. Securitization solves a number of these problems and allows investors to achieve more direct legal claim on loans and portfolios of receivables, and enables these investors to tailor interest rates and credit risk exposure to suit their needs. Because of this intermediation, the cost paid by borrowers can be effectively lower, where the risk-adjusted return to investors can be enhanced. At the same time, banks can improve their profitability by increasing loan or originations and the related fees. They can lend more. They can lend more than they would be able to lend if they were able to engage in only these activities. They could finance themselves with their own deposits, debt, and equity by allowing banks to increase the amount of funds available to lend. Securitization ultimately benefits individuals, governments, and companies that need to borrow. Securitization also has the benefit to investors. Securitization enables financial innovation, which allows investors to access securities with profiles that match their risk, return, and maturity needs. that are otherwise not directly available. For example, a pension fund who, with a long-term horizon, can gain access to long-term real estate loans by investing in residential MBSs without having to invest in bank bonds or stocks. Although few institutional or individual investors are willing to make a purchase security back by such loans or receivables, the ABS that are created by pooling these loans and receivables have characteristics similar to those of a standard bond and do not require the specialized resources and the expertise needed to originate, monitor, and collect the payments from the underlying loans and receivables. As a result, investors can add their portfolio exposure to the risk return characteristic provided by a wider range of assets if they so desire. Note that in many countries, the sale of ABS is similar to instruments that is restricted to investors who meet certain qualifications, such as those pertaining to the net worth. How securitization works. When assets are securitized, several legal and regulatory conditions must be satisfied. A number of parties participate in the process to facilitate the transaction to ensure these conditions are met. In this section, the typical securitization is described by ways of hypothetical example. The example described to parties involved in securitization and their roles also introduces the typical structure of securitization, such as credit trenching and time trenching. Examples of securitization. So, okay, this is asset-backed securities, and an example is the mortgage-backed securities. To do so, special purpose entity, a legal entity that the title of the assets are placed under. Okay. Parties to a securitization and their role. Securitization requires the publication of a prospectus, a document that contains information about securitization. The three main parties to a securitization are the seller of the collateral, sometimes called the depositor, the SPE that purchases the loan or receivable and uses them as a collateral to issue the ABS, the servicer of the loans. Okay, so just the person that gives the loans, the person that buys the loans and package it up as an investable grade loan or investable vehicle, and then the purchaser and the investor that buys the vehicle and effectively invests in the asset-backed security that derives its value from the underlying collateral. Other parties are also involved in securitization: independent accountants, lawyers, attorneys, trustees, underwriters, rating agencies, and financial guarantors. All these parties, including the servicers, when it is different from the seller or of the collateral, are referred to as the third party to the securitization. A significant amount of legal documentation is involved in the securitization. Lawyers, attorneys are responsible for preparing the legal documents. An important legal document is the purchase agreement between the seller and the collateral and the SPE, which sets forth the representation and warranties that the seller makes about the asset. So that these representations are warranties assured investors about the quality of the asset, an important consideration when assessing the risk associated with ABS. Asset-backed securities. Another important legal document is the prospectus, which describes the structure of the securitization, including the property of the amounts of payments to be made to the servicer, administrator, and the asset-backed security holders. Securitization often uses several forms of credit enhancements, which are documents in the prospectus. Credit enhancements are the provisions that are used to reduce credit risk for the bond issue. Structure of the securitization. A simple securitization may involve the sale of only one class of bonds or ABS. Let us call this class of bond Class A. Returning to the MEDIQUIP and the MET example, MET may raise $200 million by issuing 200,000 certificates of a bond, Class A bond, with a par value of 1,000 per certificate. Thus, each certificate holder is entitled to 200,000th of a payment from the collateral after payments of servicing and other administrative fees. When these fees represented is discussed in section 5.1.1, the structure of the securitization is often more complicated than a single class of ABS. As mentioned earlier, it is common for securitization to include a form of internal credit enhancement called a subordination, also referred to as a credit tranching. In such a structure, there is much more than one bond class or tranche, and the bond classes this differs as how they will share any losses resulting from defaults of a borrower, whose loans are in the collateral. The bond classes are classified as a senior bond class or subordinated bond classes. Hence, the reason the structure is also referred to as a senior or subordinate structure. The subordinate bond classes are sometimes called the non-senior bond classes or the junior bond classes. The creation of bond classes that processes different expected maturities is referred to as time tranching, and is further discussed in section 5.2. It is possible and quite common for the securitization to have structures with both credit tranching and time tranching. Key roles and special purpose entities. The SPE plays a pivotal role in securitization. In fact, the setup of a legal entity that plays the same role as SPE in terms of protecting the rights of ABS holders is a prerequisite in any country that wants to allow securitization. Indeed, without a provision of a country's legal system for the equivalent of a SPE, the benefits of using securitization will be entirely by an entity seeking to raise funds would not exist. Let us explain why by returning to our example involving MedEquip and MET. MET. So this is just an example. The SPE is a bankruptcy remote for the seller of the collateral, which means that the bankruptcy of the seller of the collateral will not affect the holder of the securities issued by the SPE. And backed by the collateral, the security holder faces credit risk only to the extent that the borrower would claim the SPE has purchased defaults on their loans. The SPE's ability to make cash payments to the security holders remains intact for as long as the borrowers make the interest payment and or the principal repayment on the loan. However, all countries do not have the same legal framework. Impediments have arisen from the countries with respect to issuance of ABSs because of a concept of trust law is not always well developed globally as it is in the US and many other developed countries. Thus, investors should be aware of legal considerations that apply in a jurisdiction where they purchase ABSs. Residential mortgage loans. Before describing the various types of residential mortgage-backed securities, this section briefly discusses the fundamental features of the underlying asset. Residential mortgage loans. The mortgage designs described in this section are those that are typically securitized. A mortgage loan, or simply a mortgage, is as a loan secured by the collateral of some specified real estate property that obliges the borrower to make a predetermined series of payments to the lender. The mortgage gives the lender the right to foreclose on the loan if the borrower defaults. This is a foreclosure, allows the lender to take possession of the mortgage property and then sell it in order to recover funds towards satisfying the debt obligations. Typically, the amount of the loan advanced to buy the property is less than the property's purchase price. The borrower makes a down payment, and the amount borrowed is the difference between the property's purchase price and the down payment. When the loan is first taken out, the borrower's equity in the property is equal to the down payments on time. As the market value of the property changes, the borrower's equity also changes. It also changes as the borrowers make a mortgage payments that include principal repayments. The ratio of the amount of the mortgages to the property's value is called the loan-to-value ratio, the LTV. The lower the LTV, the higher the borrower's equity. From the lender's perspective, the higher the borrower's equity, the less likely the borrower is to default. Moreover, the lower the LTV, the more protection the lender has for recovering the amount loaned. if the borrower does default and the lender repossesses and sells the property. In the U.S., market participants typically identify two types of mortgages based on credit quality of the borrower: prime-time loans and subprime loans. Generally, for a loan to be considered prime, the borrower must be viewed as having high credit quality. That is, the borrower must have strong employment and credit histories, income sufficient to pay the loan obligations, and substitutional equities in the underlying property. If the borrower has lower credit quality, for the loan is not a first lien on the property, then the loan is treated as a subprime. In the U.S., the typical maturity for a mortgage ranges from 15 to 30 years. For most countries, in Europe, the residential mortgage typically has a maturity between 20 to 40. In some countries, such as France and Spain, it could be as long as 50. Japan is an extreme case. The maturity of mortgages can be 100 years. Note that what is called a term in mortgage is the number of years to maturity. Interest rate determination. The interest rates on a mortgage is called the mortgage rate, contract rate, or note rate. How the mortgage rate is determined varies considerably among countries. The four basic ways that the mortgage rate can be specified are as follows: the fixed rate, the adjustable or variable rate, the initial period fixed rate, or the convertible. Amortization schedule. In most countries, residential mortgages are amortizing loans. The amortization of a loan means the gradual reduction of the amount borrowed over time, assuming no repayment are made by the borrower. The periodic mortgage payments made by the borrower consist of interest payments and scheduled principal repayments. The scheduled principal repayments is the amount of reduction of the outstanding mortgage balance and is thus referred to as the amortization. As discussed in the previous reading, there are two types of amortizing loans: fully amortizing loans and partially amortizing loans. In a fully amortizing loans, the sum of all the scheduled principal repayments during the mortgage's life is such that when the last mortgage payment is made, the loan is fully repaid. Most residential mortgages in the U.S. are fully amortizing loans. In a partially amortizing loan, the sum of all the scheduled principal payments is less than the amount borrowed. The last payment that has to be made is then to be unpaid mortgage balances, and the last payment is said to be a balloon payment. Yes. Prepayment options and payment penalties. Prepayment is any payment towards the repayment of a principal that is access to the scheduled principal payment. Repayment, a mortgage may entitle the borrower to prepay all or part of the outstanding mortgage principals prior to the scheduled due date when the principal must be repaid. The contractual provision is referred to as the payment option or the early repayment option. From the lender's or investor's viewpoint, the effect of the prepayment option is that the amount of timing of the time cash flow from the mortgage cannot be known with certainty. This risk was referred to as prepayment risk in Section 3. A prepayment risk affects all mortgages that allow prepayment, not just the level payment, fixed rate, fully amortized mortgages. The mortgage the mortgage may stipulate some sort of monetary penalty when a borrower repays within a certain time period after the mortgage is originated, and the time period may extend the full life of the loan. Some mortgages decisions are referred to as prepayment penalty mortgages. Right to the lender in a foreclose. Right of the lender in a foreclose, the mortgage can be a recourse loan, could be a recourse loan or a non-recourse loan. When a borrower fails to make the contractual loan payment, the lender can repossess the property and sell it, but in the process, the proceeds received from the sale of the property may be insufficient to recoup the losses. In a recourse loan, the lender has a claim against the borrower for the shortfall between the amount of the outstanding mortgage balance and the proceeds. received from the sale of the property in a non-recourse loan. The lender does not have such a claim and thus can look only at the property to recover the outstanding mortgage balance. In the U.S., recourse is typically determined by the state, and residential mortgages and non-recourse loans in many states. In contrast, residential mortgages in most of Europe, in most European countries, are recourse loans. The recourse / non-recourse features of mortgage has implications for projecting the likelihood of default by borrowers, particularly in the case of what is sometimes called the underwater mortgages. That is, mortgages that are viewed, yeah. Now the basics of residential mortgages have been set out. We can turn our attention to how these mortgages are securitized, that is, being transformed into the MBS. In the following sections, we focus on the U.S. residential mortgage sector because it is the largest in the world, and many non-U.S. investors hold U.S. mortgage-backed securities in their portfolios. Residential mortgage-backed securities, the bonds created from the securitization of mortgage related to the purchase of residential properties, are residential mortgage-backed securities, or RMBSs. In such countries as the U.S., Canada, Japan, South Korea, distinction is often made between the securities and the guarantee and that are guaranteed by the government or a quasi-government entity, and the securities that are not quasi-government entities are usually created by governments to perform various functions for them. Examples of quasi-government entities include government-sponsored enterprises, GSEs, such as Fannie Mae, the Federal National Mortgage Association, the Freddie Mac, in the U.S. and Japan, housing finance agencies. In the U.S., securities backed by residential mortgages are divided into three sectors: those guaranteed by financial agencies, those guaranteed by GSE, and those issued by private entities that are not guaranteed by a federal agency or GSE. The GSE, once again, is a government-sponsored agency. The first two sectors are referred to as the agency RMBS. RMB is not renminbi. It's not the Chinese dollar, Chinese currency, Chinese yuan. And the third sector are non-agency, or RMBS. Mortgage pass-through securities. A mortgage pass-through security is the security created when one or more holders of mortgages from a pool of mortgages and sells shares or participation certificates in a pool. A pool can consist of several thousands of only a few mortgages. When a mortgage is included in a pool of mortgages that is used as collateral for a mortgage pass-through security, the mortgage is said to be securitized. Characteristics: the cash flow of a mortgage pass-through security depend on the cash flow of the underlying pool of mortgages. The cash flow consists of monthly mortgage payments representing interest, the scheduled repayments of principal, and any payments of cash. Cash payments are made to security holders each month. Neither the amount nor the timing of the cash flow from the pool of mortgages, however, is necessarily indicated to that of the cash flow passed through to the security holders. In fact, the monthly cash flow of a mortgage pass-through security are less than the monthly cash flow of the underlying pool of mortgages by any amount equal to the servicing of other administrative fees. The servicing fee is the charge related to servicing the mortgage. Servicing involves collecting monthly payments from borrowers, forwarding proceeds to owners of the loan, sending payment notices to borrowers, reminding borrowers when payments are overdue, maintaining records of the outstanding mortgage balance, initiating foreclosing proceedings if necessary, and providing tax information to borrowers when applicable. The servicing fee is typically a portion of the mortgage rate. The other administrative fees are those charged by the issuer or financial guarantor of the mortgage through security and the guaranteeing of the issue. I'm drinking honey. Wait, what am I drinking? It says I am drinking honey lemon tea. Honey lemon tea. So it's honey lemon with tea. It's quite sweet, so I do a 3-to-1 ratio of water to this tea. So I have 3 times the amount of tea, 3 times the amount of water as I do have the tea, because it's really sweet. And I like my tea diluted, so I can have more water, stay hydrated. An investor who owns mortgage-backed securities does not know what this future cash flow will be, because these future cash flows depends on the actual prepayment. As we noted earlier, the risk is called the prepayment risk. The prepayment risk has 2 components: contraction risk and extension risk, both of which largely reflect changes in the general level of interest rates. Contraction risk is the risk that when interest rates decline, actual prepayments will be higher than forecasting, because homeowners will refinance at now available lower interest rates. Thus, a security backed by mortgages will have a shorter maturity than was anticipated at the time of purchase. Holding a security whose maturity becomes shorter when interest rates have declined has 2 adverse consequences for investors. First, investors must reinvest the proceeds at lower interest rates. Second, if the security is prepayable or callable, its price appreciation is not as great as that of an otherwise identical bond, and does not have a prepayment or call option. Okay. Collateralized mortgage obligations. As noted in the previous section, prepayment risk is an important consideration when investing in mortgage pass-through securities. Some institutional investors are concerned with the extension risk, and others with contraction risk. The structuring of a securitization can help redistribute the cash flow of mortgage-related products. The different bond classes are tranches, which leads to a creation of securities that have different exposures to prepayment risk, and thus different risk return patterns relative to mortgage-related products from which they were created. When the cash flows of mortgage-related products are redistributed to various tranches, the resulting securities are called collateralized mortgage obligations, or CMOs. The mortgage-related products from which the cash flows are obtained are considered the collateral. Note that in contrast to mortgage pass-through security, the collateral is not a pool of mortgages but a mortgage pass-through security. In fact, in practice, the collateral is usually a pool of mortgage pass-through securities. Hence, the reason market participants sometimes use the term collateral and mortgage pass-through securities interchangeably. Okay. Non-agency residential mortgage-backed securities. Agency RMBS are those issued by these organizations, issued by another entity of a non-government agency. RMBS and type entities that issue non-agency RMBS are typically thrift institutions, commercial banks, and private conduits. Private conduits may purchase non-conforming mortgages, pool them, and then sell mortgages through pass-through securities whose collateral is the underlying pool of non-conforming mortgages, because they are not guaranteed by the government or GSE. The credit risk is an important consideration when investing in non-agency RMBS. Non-agency RMBS share many features and structuring techniques with agency CMOS. However, because non-agency RMBS are not guaranteed by the U.S. government or by GSE, or government-sponsored enterprises or entities, they that can provide protection against losses and oppose some forms of internal or external credit enhancement is necessary to make these securities attractive to investors. These credit enhancements allow investors to reduce credit risk or transfer credit risk between bond classes, thus enabling investors to choose their risk return profile that best suits their needs. Credit enhancement also plays an important role to obtaining favorable credit ratings, which make non-agency RMBS more marketable to investors. The level of credit enhancement is usually determined relative to the specific credit rating desired by the issuer for a security. Note that one of the consequences of the 2007 to 9 credit crisis has been an overall increase in the level of credit enhancement. As mentioned in section 3.3, subordination or credit tranching is a common form of credit enhancement. The subordination levels are set at the time of issuance. However, the subordination levels changes over time as voluntary repayment defaults occurs. To protect investors in non-agency RMBS, a securitization is designed to keep the amount of credit enhancements from deteriorating over time. If the credit enhancements for senior tranches deteriorates because of poor performance of the collateral, a mechanism called shifting interest mechanisms locks out subordinated bond classes from receiving payments for a period of time. Many non-agency RMBSs also include other credit enhancements such as over collateralization and reserve accounts. When forecasting the future cash flow of non-agency RMBSs, investors may consider two important components. The first is the assumed default rate of the collateral. The second is the recovery rate. Because even though the collateral may default, not all of the outstanding mortgage balances may be lost. Commercial mortgage-backed securities. Commercial mortgage-backed securities, or CMBSs, are backed by a pool of commercial mortgages on income-producing properties such as multifamily properties, office buildings, industrial properties, including warehouses, shopping centers, hotels, healthcare facilities, etc. To collateralize, the collateral is a pool of commercial loans that were oriented either to finance a commercial purchase or to refinance prior mortgage obligations. In the U.S. and other countries where commercial mortgages and non-resource loans are non-resource loans, the lender can look only at the income-producing property backed the loans for interest payments and the principal payments if the default occurs, and lenders can foreclose the commercial property, but it can only use the proceeds from the sales that the property is to recover the principal outstanding, and it has no recourse to the borrowers and other assets or incomes. For any unpaid balance, the lender must view each property individually, and lender evaluates each property using measures that have been found useful in assessing credit risk. CMBS structure. A credit rating agency determines the level of credit enhancement necessary to achieve a desired credit rating. For example, if specific loans to value and DSCs ratios are needed and those ratios cannot be met at the loan level, subordination is used to achieve the desired credit rating. Interest on the principal outstanding is paid to all tranches. Losses arising from loan defaults are charged against the outstanding principal balance of the CMBS tranche. In this case, the unrated tranche is called the first loss piece, or residual tranche or equity tranche. Call protection, a critical investment feature that distinguishes the CMBS from RMBS is the protection against early repayment available to the investors, known as the call protection. An investor in the RMBS is exposed to a considerable prepayment risk because the borrower has the right to prepay a loan in whole or in part before the scheduled principal payment date. As explained in Section 4.4, a borrower of the U.S. Usually does not pay any penalty for prepayments. The discussion of CMOs highlighted how investors can purchase certain types of tranches to modify and or reduce prepayment risk. Non-mortgage asset-backed securities. Numerous types of non-mortgage assets have been used as collateral in securitization. The largest in most countries are auto loans and lease receivables, credit card receivables, personal loans, and commercial loans. What is important to keep in mind is that regardless of the type of asset, ABS are that are not guaranteed by a government or a quasi-government entity are subject to credit risk. ABS can be collateralized on the basis of which the collateral repays. That is, whether the collateral is amortizing or not amortizing. Traditional residential mortgages and auto loans are examples of amortizing loans. The cash flow of an amortizing loan includes interest payments, scheduled principal repayment, and any repayments of, if permissible. If the loan has no schedule for paying down the principal, it is a non-amortizing loan because a non-amortizing loan does not involve secured principal repayments. ABS backed by non-amortizing loans is not affected by prepayment risk. Credit cards, receivables, ABS is an example of ABS backed by non-amortizing loans. Auto loans, we got credit card ABSs. Collateralized debt obligations. Collateralized debt obligations, or CDOs, is a generic term used to describe a security backed by a diversified pool of one or more debt obligations. CDOs, backed by corporate and emerging market bonds, are collateralized bonds obligations. CDO backed by leveraged bank loans are collateralized loans obligations. CDOs backed by ABS or RMBS or CMBS and other CDOS are structured finance. CDOSs are backed by a portfolio of credit risk default swaps for other structured securities and synthetic CDOs. CDO structure. The CDO involves the creation of SPA, as usual. In the CDO, there is a need for the CDO manager, also called a collateral manager, to buy and sell debt obligations for and from the CDO's collateral to generate sufficient cash flows to meet the obligations to the CDO bond holders. Okay. Summary. Okay, let's get into the summary. Securitization involves pooling debt obligations such as loans and receivables and creating securities backed by the pool of debt obligations called asset-backed securities. The cash flow of the debt obligation are used to make interest payments and principal repayments to the holders of the ABS. Securitization has several benefits. It allows investors direct access to liquid investments and payment streams that would be unattainable if all the financing was performed through banks. It enables banks to increase loan orientations at economic scales greater than if they used only their own in the house loan portfolios. Thus, securitization contributes the lower cost of borrowing the entities raising funds, higher risk-adjusted returns to investors, and greater efficiency and profitability for the banking sector. The parties of securitization include the seller of the collateral, the pool of loans, the servicer of the loans, the special purpose entity, the SPE. The SPE is a bankruptcy remote, which plays a pivotal role in securitization. I'm surprised they didn't even mention the 2008 financial crisis brought about by subprime mortgage crisis or the subprime mortgage loans. This whole thing is a securitized asset-backed security. I'm surprised this chapter never even brought it up or even mentioned it. So it's kind of shocking, you know. It's a big history of securitization. It's a big history of asset-backed securities. They at least should mention it. The parties to securitization includes, I mean, it's 10 years ago, but it's still really fresh in our minds. So more than 10 years, more like 13 years, but still. The parties to a securitization includes the seller of the collateral, servicer of the loan. Okay, we have that already. The common structure of securitization is a subordination, which leads to the creation of more than one bond class or tranche. Bond classes differs as to how they will share any losses resulting from defaults of the borrower whose loans are in the collateral. The credit rating assigns to the various bond classes depend on how the credit rating agencies evaluate the credit risk of the collateral and any credit enhancements. The motivations for the creation of different types of structures is to redistribute prepayment risk and credit risk efficiently among different bond classes. And securitization prepayment risk is the uncertainty that the actual cash flow will be different from the scheduled cash flow as set forth in a loan agreement, because borrowers may choose to repay the principal early to take advantage of interest rate movements. Because SPE, the securitization of a company's assets, may include some bond classes that have better credit rating than other companies itself, or the corporate bonds. Thus the company's funding cost is often lower when raising funds through securitization than when issuing corporate bonds. A mortgage is a loan secured by the collateral of some specified real estate property that obliges the borrower to make a predetermined series of payments to the lender. The cash flow of a mortgage includes interest, scheduled principal payments, and prepayments. The various mortgage design, so these are just the content. So I do hope my readings have been helpful, and let's not forget the show notes are in the description. You guys just head to Amazon to get it, and I do hope to see you guys in the next section. We'll be talking about fixed incomes, about reading 54, and I hope to see you guys there. Okay, goodbye.